So if you want to set your kids up financially, besides teaching them financial literacy and good money habits, there are 4 accounts that you need to understand. So in this video, I'm going to walk you through the pros and the cons of each account, some of the major gotchas, things like taxes, student aid, and more. By the end of this video, you should understand what account should work for you or accounts, some of the major gotchas and the things that you need to be mindful of as you move forward. If you're new here, welcome to the channel. My name is Ethan Ho, certified financial planner, your financial advocate, and the founder of Kālā Capital. Around here, we're all about helping you make smart and empowered money decisions. So let's jump in to the accounts that can benefit your kids financially. In the last few weeks, I've had this question come up at least 4 different times in various conversations with clients, but it's how do I save and invest to help my children out, to benefit my children? That's the spark for today's video. So here is the roadmap. We're going to cover the 529 college savings plan, the UTMA or UGMA accounts that are custodial accounts for children, the Roth custodial accounts, and then finally the parents brokerage account. Each one of these accounts has a different purpose. So I want to give you the high level overview of understanding how they work, how they could work for you, so you can make an empowered, informed decision on what accounts to use, not to use, and how it could all work together. So the first account that we should be discussing today is the 529 college savings plan. There are specific state 529 college savings plan, but there's also a general nationwide college savings plan, 529 college savings plan, that I'm going to be speaking more about today. The intention with the 529 college savings plan is to use the proceeds for higher education. The benefit here is that money can go into the account and grow tax deferred and then ultimately tax free if used for a qualifying expense. A qualifying expense could be anything from tuition, room and boards, books, electronics, whatever is going to support the child's educational pursuit. Recent changes in the law have expanded what you can use the college savings or the 529 plan for. It does allow you to access some of the money prior to college, grades K through 12, and recent changes in the law have opened up the doors for potentially rolling that 529 plan into an IRA account much later down the road in retirement if you meet certain restrictions or parameters. These accounts are typically best for educational focused families. If you know your child's going to college, if you know that they're going to pursue some level of education and you want to set money aside to fund education specifically, these accounts are your tax advantage workhorse in that sense. So some nuances to be mindful of when it comes to the 529 college savings plan is that you can have a state specific plan that comes with state specific benefits. Some of them is tax deductible and you can get a potentially tax credit on it. But for the sake of this conversation, we're going to keep it to the national plan. The 529 college savings plan at a national level will give you federal tax benefits and not state tax benefits. So a solid action step for you is to check if your state has a meaningful tax deduction when it comes to the state specific 529 plan. And if not, then consider a national based plan. So your 529 account is your educational focused account. But what if you don't think your kid's going to go to college? Or what if you don't want to pay for college? Or what if you don't want to have restrictions around what the money could be used for, making it specifically education focused? Then your next option is the UTMA or UGMA account. A UTMA is an irrevocable account where the child owns the assets, but you as the guardian get to control the assets. This account is good for general expenses, things like buying your first car, putting a down payment on a home, or any other expense that is going to support the child's well-being. So the benefit here is that the use case for this account is extremely broad. Anything that supports the child is good to go. The other benefit here is that it teaches ownership to the child. The assets are truly theirs. You're just controlling it while they're underage, so they can watch their portfolio grow. They can have a say in how it's invested. It can be a discussion point for you to chat with them at your family meeting and teach them more about financial literacy, accountability, and how investing works. There are also no state plan rules here to navigate, so it makes it a little bit less complex. The major gotcha that you need to watch out for here is the fact that it's irrevocable. So if you gift your child money, put into one of these accounts, when they turn of age, 18 or 21, depending on the state, that money is technically theirs. So what if you want to maintain flexibility, but you're not prepared to irrevocably give assets to your child just yet? This is where the parents brokerage account comes in. And essentially a parents brokerage account is a typical brokerage account that is earmarked for the child. Oftentimes with our clients, we will break this off and create a separate brokerage account. So the accounting is clean. So you know that you're contributing $50 a month or $100 a month or whatever it is to that specific account. And it has a time horizon and investment strategy tied to when you want to give that money to the child. A parents brokerage account is very similar to a UTMA account. You can hold very similar investments. They basically function in the same way, besides the fact that what's put into the account is not an irrevocable asset of the child. The big thing to watch out here for is that in the future, when you do gift the money to your children, you're gonna have to be mindful of gift taxation. For many people, this is not gonna be very relevant and there's many ways around it, but it is something to be mindful of in the future, especially if you're gonna give a large sum of money. So some things to be mindful here is that you're not gonna get any unique tax benefit to using a parent's brokerage account. And what you decide to gift to your children later will have some level of gift tax implications depending on how much you give, which needs to be adjusted with your advisor or your CPA in the future based on current laws at that time. So just be mindful when you do decide to gift those funds to your child to review the gift implications with your tax advisor. So the final account that I want to cover today is your custodial IRA account, and specifically the Roth IRA account. This is going to be an account for kids who have active income. This is your entrepreneurial minded child. Maybe they have a paper route, maybe they have an online business, but they are earning money themselves. If they have active income, they are now eligible to contribute an amount of that to an IRA account. And if they are underage, a custodial IRA account. Our favorite when this happens is the Roth account, so proceeds can grow tax-free and come out in retirement tax-free. These accounts are so awesome because contributions to the account, the principal amount that you put in, is going to be accessible at any time to the child without penalty, but growth on that account can grow tax-free if used for retirement. It's an amazing way to build a good financial base and habit for the child, to give them ownership, to allow them to capitalize on compounding for a long period of time. If you think about the child who is earning an income at 14 and saving and investing some of that, they're going to get an extra decade or two of compounding interest working for them than the average person. So the big watch outs here is that the child needs to have earned income, and the contributions are going to be limited to the IRA limit or the full amount of their earned income. So if they make only $3,000 for the year, they can only put up to $3,000 into an IRA account. If they make $30,000 in the year, they're going to be subject at the max IRA contribution limit. And as I'm filming this today, it's $7,000. So it's going to be the lesser of the two. This is a retirement account for the child. So if you do set up one of these accounts, set the expectation with the child that you're not going to pull money out of that account until retirement. And if you do, you need to make sure that it's principal only and you don't touch the earnings portion of it, because if you do touch the earnings portion of it, it is going to be subject to tax and penalty. So there you have it. Those are the 4 accounts that you must understand if you want to help set your kids up financially. It's your 529 college savings plan. This is your educational focused account. It's your UTMA account or UGMA account, which is an irrevocable gift to the child. It is your custodial IRA account, ideally Roth IRA account, which is your retirement account for kids with earned income. And last but not least is the parent's brokerage account, which allows you to maintain complete control but comes with no major tax benefits. And you must be mindful of gift implications later on in the future. Finally, I feel like I would be doing a disservice if I don't mention that all these accounts are going to be amazing vehicles to teaching your child accountability, ownership, financial literacy, and long-term thinking. The biggest benefit you can give your kid is not necessarily a ton of money in whatever account you choose, but it's the ability to live on less than you earn, think long-term, delay gratification, and take true ownership over your financial decisions and then the assets that you own. Having any one of these accounts is going to give you a real case study to sit down, discuss with your child what's important to them, what they're going to use the money for, how it's being invested, how it's working for them, to instill these behaviors at a young age, because that is going to be the most valuable thing you can do for your kid, period. Teach them how to fish, don't just give them a fish. If you found this topic interesting or helpful, please leave a comment, and subscribe to the channel. It is the easiest way to share this message with other people who could also benefit from this information. And with that, hopefully this video gives you some direction on how to save and invest for your child's future. If you found this helpful, I invite you to join my free school community. Link is in the description below. And if you're looking to work with a financial advisor, that's exactly what we do here at Kālā Capital. Again, link is in the description below.